And we have completed our syllabus. We know we have 8 chapter or 8 module, and last class we have completed it. So today we'll discuss few items: company valuation under dividend valuation model, discount cash flow basis, valuation of debt and preference share, a few share debenture, some NPV calculation, risk adjusted NPV, weighted average cost of capital under book value method and market value method, corporate restructuring, concept and measurement of the cost of capital, and credit policy and planning of working capital, etc. So it's also a review class of corporate financial management. So here, if we see here, earning per that's my EPS. What that means? Earning yield method. What is that? Income-based method is the earning yield method. So earnings yield we can calculate this way: EPS, earning per share, if we divide by MPS, market price per share. Sometimes we are calling that MPS, market price per share, and this method and multiply by 100, and we can calculate the market value. How? Earning per share divided by earning yields. So this earnings yield, calculate this way, this is earning yields. So if we want to find out the market value of a instrument or share, we can calculate this way. First we have to calculate earning yield, and then we can calculate market value. And there are different types of method also. If we see this one, a company has earnings 3 lakh USD. A similar listed company has an earnings yield of 12.5%. Company M3, another company, has earning 4,20,500. A similar listed company has P, price earning ratio is 7. So from this data, estimate the value of each company. Here, two company, one is FIR, another is M3. So have to estimate the value of each company. Look here, for the FIR company, it's earning 3 lakh, and then its earnings yield, look here, earnings yield is 12.5%. So this one, 12.5%, this 1 divided by 0.100, that means we come here, the estimated value of the company FIR, 24 lakh. And company M3, another company, its earning is 4,20,500. As price earning ratio, look at previously it was earnings yield, and here price earning ratio is 7. So price earning ratio 7 multiply by the earnings, multiply earnings equal to, will get the value of the company. $29,43,500 is the value of the company M3. Sometimes that type few item 4 or 5 marks can be added with a math also in our CS exam. So here one other one, dividend valuation model. DVM, we know it. Dividend valuation model is based on the theory that an equilibrium price of any share on a stock market, that is the future expected stream of income from the security or instrument, and discounted at the suitable cost of capital. So this is this way we can calculate it. So equilibrium market price is thus a present value of future expected income stream. The annual income stream for a share is the expected dividend every year in perpetuity. The basic dividend basis formula for the market value of share is expressed in DVM. So we call it DVM formula. DVM means dividend valuation model. Assume here if no growth, that formula would be that one, market value equal to D minus KE. So what is D? Here D is, look here, if we see later on, if the dividend of constant growth, dividend growth model can be applied this way. PO, here PO means market value excluding any dividend current payable, equal to, here we can say this way, here it's also a formula, DO multiplied by 1 plus G. Here G means growth rate in the earning and dividend. K minus G. K means shareholders required rate of return, or we can say cost of equity, and equal to D1. D1 means here, D calculate here, D1 calculating this way. D1 means expected dividend in 1 year's time divided by K shareholders required rate of return minus growth rate. So this is the formula for dividend growth model. So by this formula we can calculate this way. Here another problem is a part of another problem, now is 85B. Previously it was 85A. If a company paid a dividend 2,50,000 this year, the current return to shareholders of companies is the same industry is 12%. Although it is expected that an additional risk premium of 2% will be applicable to the company, being a smaller and unquoted company. So we know it, what is unquoted, what is quoted. So quoted means the company are listed. It's an instrument we can quote. We can quote for buy or sell. This is the quoted. And unquoted means is not listed company. So here compute the expected valuation of the company if the current level of dividend is expected to continue into the foreseeable future. The cost of equity here, look here, the industry is 12%. Here is the return of industry return is 12%. And with this 12%, 2% is risk premium is expecting additional. So here 12 plus 2% equal to 14%. This KE equal to 14%. DO here dividend in the 0 year 2,50,000. This one 2,50,000 and growth rate 4%. So the question is growth rate G 4%. DO divided by KE, here DO 2,50,000 divided by 14%. So here in the case of 1, the current level of dividend where no growth is here. Dividend expected to continue into a foreseeable future. Current level, no growth. So here valuation is, company's valuation is $17,85,714. And if you consider the growth for person, that company valuation is come 26 lakh. And if we see another one, if a company has the following financial information available, share capital is issue 4 million ordinary share at the par 50 cents, that means $0.50. Current dividend per share just paid 24 cents. Dividend 4 years ago 12.25 cents. Current equity beta 0.8. You also have the following market information. Current market return 15%, risk-free rate 8%. When we will see that type of item, that is beta, risk-free rate, expected return or risk premium, current market return, that means that we have to use the CPFA method for calculating the cost of equity. So this is the indication. Here, find out the market capitalization of the company. Market capitalization is found by multiplying its current share price by the number of share issue. So here we calculate cost of equity under the CPFA method, is the note also. Here formula is that, and in the dividend in the 0 year 24 cents, G can be found here. calculated 12% this one. Based on the data, we have to calculate the cost of equity using the capital asset pricing model formula, and we know it risk-free rate of return plus beta multiplied by market risk minus risk-free rate of return. This is the fundamental and basic formula of CFM method. So based on that formula, if we put all data that's given in our question, so here cost of equity comes 8% risk-free rate of return, market beta is 0.8, multiply by market risk-free rate of return 15%, market risk 15%, and risk-free rate of return 8%. So if we calculate all things, then we will get 13.6% is the cost of equity. So this 13.6% is this one. So therefore, the value, we're saying that find out the market capitalization of the company. So market capitalization of the company 16.8 is come the million and also million. This is the 4 million. So here total market capitalization 16.8 million. We have to write it million. As the following financial information available, share capital is issued 2 million ordinary share at par value $1 or 1 taka. Current dividend per share just paid 18 paisa. That means 0.18 taka or dollar. Current DPS $0.25 or 25 cents. Current return earnings as a 20%. Current equity beta 1.1. You also have the following market capitalization as a market information. Current market return is 12% and risk-free rate of return 5%. So based on the data, if we see the beta, risk-free rate, current, we have to use the CFM formula for calculating the cost of equity. So find the market capitalization of the company as same previously what we did in this one here. After calculating all things, we will get the value of the company is 5.36 million. So all calculation here as CFM based on the CFM formula, we calculated the cost of equity. It's come 12.7%. So it's on. So market capitalization is therefore 2,268 multiply equal to 5.36 million. So assumption of dividend model. Let's say there is some assumption of dividend model if we go for calculation, and now valuation under discounted cash flow is also important thing for us. Sometimes we that type of math can be sometimes come here. Identify how we can calculate, identify relevant free cash flow. So what is the free cash flow? We know the cash flow, but what is the free cash flow? Free cash flow exclude operating flow, revenue from sale of asset, tax, etc. Sometimes we have some commitment for fixed asset and other things. So deducting that type of actual commitment from the cash flow, then we will get the free cash flow. That means that cash flow is free for use. There is no bindings. So it's called the free cash flow. There is no obligation with that cash flow. But overall cash flow we have as per IS 7, we are calculating cash flow. And we know there is in the cash flow there are three activities, operating activities, investing activities, and financing activities. And also we know cash flow we can calculate two ways. One is direct method, another is indirect method. And what is direct method? All inflow and outflow calculated directly within this operating activities. So is the direct method of cash flow. And when we start from the balance of the profit and loss account, it can be profit, can be loss, then we will adjust with all that means adjustment, for example depreciation, amortization, other thing that is not in the cash expenses, but its expenses allowable, and tax authority also allow it, but it's no cash out from that expenses. So that type of expense we should include in the cash flow, and also is taking for the decision making, also managerial decision making. So here free cash flow is, that means no obligation with that cash flow. So we have to select the suitable time horizon, we have to calculate the present value, etc. So this way we can calculate thing. This one is that type of math here. If we see 86 number math, the following information has been taken from the income statement and a statement of financial position of a company. Revenue 350 million, production expense 210 million, administrative expenses 24 million, tax allowable depreciation 31 million, capital investment in the year 48 million. So corporate debt 14 million, trading at 130%. Tax rate is 13% and weighted average cost of capital 16.6%. Inflation is 6%. This cash flow are expected to continue every year for the foreseeable future. Calculate the value of the equity. So we have to calculate the value of the equity. First, we have to calculate the operating profit. What would be the operating profit? Here, 350 is the revenue. So from that revenue, we have to minus production expense and administrative expense. Then operating profit is come here, 116 million. So tax and operating profit, it would be 116 million multiplied by 30%. So the tax is 34.8 million. So allowable depreciation 31 million here, saying that tax allowable depreciation, this one. So this depreciation we have to add with the cash flow also. Look at as not included in the production of administrative expenses. So tax relief from that depreciation. Why that type of relief? Because tax is a depreciation is the expenses and allowable expense. So depreciation increase the total expenses and reduce the net profit. And if reduce the net profit, tax also reduce. And DCT is allowing that type of expenses depreciated as per tax law in our country. So depreciation is a non-cashable item, that means no cash out by the depreciation, but it's also an expense. So here tax relief on depreciation is 13% of that depreciation. So at this question, 9.3 million we can relieve tax from this, because this is an allowable expense. Therefore, net cash, what would be that? Here, operating profit 116. From that, we have to minus the here that tax on operating profit. This is the tax. We should pay the tax, and also we have to add the tax benefit from the depreciation for actual cash flow, calculating the actual cash flow as well as decision making. So 9.3 million is the tax relief on depreciation amount, and from 48 million minus. So what is the 48 million? This is the 48 capital investment in the year. This means cash out equal to F. Therefore, net cash flow is 42.5 million. So 42.5 million is the cash flow. Here, the real discount rate. What is the discount? That means here, look here, inflation rate is 6%. 1.06. This one means that is the 100%. So real discount 16.6%. Here adding 1 divided by discount, that is actually real discount rate 10%. So there another formula is that sometimes is based on the inflation, we can adjust our real expense or real income within this figure, within the rate, inflation rate, we can inflate it. And also another formula is that we can calculate the all item with the real calculate the real value, real discount rate. So if possible, then we'll see that both our item is the result would be the same. If we adjust the inflation rate or if we calculate the real discount rate, result would be the same. So here real discount rates come 10%. The corporate value is, what would be the value? Corporate that is company's value 425 million, and equity. So here 425 million minus the debt. What would be the debt here? Look here, corporate debt 14 million trading at 130%. So here 14 million multiplied by 1.3, that means 130%. If we minus from the total value of the firm, this is the debt value, debt market value. If we minus from the total corporate value, then we will get equity. Value of the equity of the firm or company is 406.8 million. Here, valuation of debt and preference share. How we would be able to evaluate debt and preference share? This is the formula sometimes. Redeemable debt without tax, the formula is that. And debt with tax, formula T means tax adjustment here. Redeemable debt, market value equal to present value of future interest, and redemption receipt discount. And preference share, this way calculate. So here PO means, that means all formulas here. Here in this math, we cover 4 items here: redeemable debt, preference share, redeemable debt, convertible debt. So here 4 items within one math. That type question may come difference exam also. For example, 5 multiplied by 4 equal to 20 marks. So it can be happen in our CS exam. Company has issued a redeemable loan note with a coupon rate 7%. So what is coupon rate? That means a specific rate for the bond also. But if the required return is investor is 4%. What is the current market value of the debt? So this is the market value. 7. What is 7? Here 7 is that 7% is coupon rate, and required rate of return of investors is 4%. So coupon rate divided by 4%, then we will get the market value of this bond is 175. Then another one, FIR has the issue $100, that's why face value is 100, 12% preference share. Currently the required rate of preference shareholder 14% required rate. So what would be the value of the preference share? So answer is that market value of preference share, here 12%, expected is for 14%. So market value is 85.71. But the issue price is $100. So preference share market value is this one, below than issue price, 85.71. And number 3, redeemable debt. If our company has issued some 9% debenture, which are now redeemable at par in 3 years' time, investor now require a redemption yield 10%. What will be the current market value of each 100 of debenture? So issued in $100, 9% debenture. So that answer would be this one. Debt in the year 1, interest 9%, second year 9%, and redemption is in the year 3 years bond debt. So 100 taka have to redeem in the year 3. So discounting factor here 10%, redemption yield. Investor now require a redemption yield 10%. So this 10% is discount factor. If we use 0.901 is the year 1, second year, third year. So if we multiply this 9%, that means 9 This 9, because value is 100. If 9%, that means $9. So $9 multiply 0.909, we will get 8.18. Same way, all if you calculate, then total 97.47. So look here, each 100 of debenture will have a market value of now $97.47. Now, convertible debt. If a company has a issue convertible loan note with a coupon rate 12%, each $100 loan note may be converted into 20 ordinary share at any time until the date of the expiry, and any remaining loan note will be redemption at $100. The loan note have 5 years left of run. Investor would normally require a rate of return 8% per annum on a 5-year debt security. Should investor convert if the current share price is 4, 5 or 6? 3 option here. So if we go the calculation, value as debt, if the security is not converted, it will have the following value of the investor. Interest at the rate that was $12 per year for 5 years. So here from the annuity factor, we will take the 5 years factor at the rate of 8%. Then we will get it 3.993, and redemption $100 after 5 years, and at the 8% PV factor we will get 0.681. So here 100 multiply 0.681, then we will get 68.10. And same way, $12 as the interest, if we multiply by 3.993, then we will get 47.96. So here total value of debt is 116. If no conversion, then value of debt is 116.016. Now, value as equity market price, value as required here, as per the question, 3 options is here: $4, $5 and $6. Value of equity market price, that 3 item that's given in the question, 4, 5 or 6. So what is this? 20 number share multiplied by $4, that value would be $80. 20 number of share if convert, then $5, then 100, 600. If the market price of equity is $6, the security should be converted, because otherwise it was more debt. The break-even conversion price 5.85 share 160 divided by 20 share, because value is 116. If we divide number of share that convert 20, then break-even would be 5.80. So this is the ideal situation. If the equity value per share is $6, that can be converted. The value of the conversion will be therefore 116, unless the share price is 5.8. That means more than 5.8, because 5.8 is the break-even. So investor will convert the debt if the equity share per would be $6, that or more than $5.8. It would be your answer. Look here, another one, risk adjusted NPV. So we calculate the NPV, net present value, as the investment decision side. We calculate IRR, we calculate PV factor, we calculate profitability index, etc. So this another one, risk adjusted NPV. So look here, if a company cost of capital is 15% and the risk-free interest rate is 10%, where the income tax rate for the company 34%, the company is considering investment in one of 3 mutually exclusive projects. So mutually exclusive project here, 3 project. ABC, that means MAB, MBC, MC. If we see inside one, ABC. So initial investment required for the project A, 12 lakh, B, 10 lakh, C, 15 lakh. And the cash inflow, that means 5 lakh, 5 lakh, the same in the 4 years. This is the 4 years life, all project. But project B, cash flow is different, inflow, and C also different, not the equivalent. And risk index is here. For the project A, 1.8, project B, 1, and project C, 6. Using the risk adjusted discount rate, determine the risk adjusted NPV for each of the project ABC, which project should be accepted by the company. So here cost of capital 15%, risk-free rate 10%, as given. The risk-free rate, interest and risk factor for each of the project is given. The risk-adjusted discount rate for different project can be found. We can use the CPFA form because this index is the beta, industry beta. And this is also the risk-free rate of return. Here, cost of capital here, which is market risk. How we can adjust? Project A, risk-adjusted discount rate, 10% is the risk-free rate of return. Is the industry, that index, industry beta 1.8, 15% market risk-free rate of return from the market, and minus 10% risk-free. Here come 19%, project A, B 15, and C 13. The 3 projects can now be evaluated 19, 15, 13. This 19, 15, and 13 discount rate. Look here. Annual inflow, because project A may be inflow is equivalent 4 years. That means 5 lakh. So easily we can calculate here in the year 4. If we go 19% PV factor, this 19%. This is the project 1's 19%. In there 4, if we go PV factor sheet, then we'll get here 2.639. If we multiply this 5 lakh with the 2.639, then we will get 13,19,500. And our initial investment was 12 lakh. So what would be the net present value? Here NPV is 1,19,500. So project A is completed. Now if we go for project B, here 4 years, a different cash flow, 5 lakh, 4 lakh, 5 lakh, and 3 lakh. If we multiply PV factor 15%, because we calculated here this one 15%. So if we take this 15% from PV factor, here first year, second year, third year, fourth year, here at the rate of 15%, fourth year PV factor is 0.572. If we multiply this one, for example 5 lakh, if we multiply, then we'll get 4,35,000. Same way, in the year 4, 1,71,000. So this one, if we get, it is the present value of the inflow of the project. The total present value is 12,38,000. And if we minus the initial outflow 10 lakh in the project B, then net present value 2,38,000. So previously we get from the project 1, 1,19,500. This one 2,38,000. Now project C, same way, that is 13% with the, if we adjust with 13% at the cash flow, then we'll get 70,34,300. And if we minus the initial cash investment, that outflow, then we'll get 274,300. So which project is more attractive here? If we see, project C is more attractive because NPV is higher than any other project here. So project MCD has highest NPV, so we should accept this project.